conversational, so we're not just listening to me talk for like 45 minutes. So welcome everybody. We're gonna start off with the market reports, just to kind of keep a pulse on the market these days. I don't know if anybody's been kind of watching that. It's interesting right now because things have definitely slowed down a little bit in some regards. We have inventory getting a little bit better, but not much. And this is compared to last year, which was a really low inventory year. So like it's still not good. We have number of home sales has gone down a good amount compared to last year. Median days in the market has creeped up a little bit, but still pretty fast. All I have to say is that we're coming off of really hot years, so any kind of change makes it look like a little bit worse. Hey, Ron. Hey. But median, we still have more demand than we have inventory, so the median sales price overall is still going up. You can see for the year to date, we have an 18.9% less home sales. We have an increase though of 10% in the median sales price. The median days in the market overall has gone up by 2 days or 40%. So again, it's slowed down a little bit, but it's certainly nothing alarming. And unless we get a big burst of supply, it should still kind of stay in this seller's market for the foreseeable future. But time will tell. Good. I just realized I have all my tags here, so you can see my tag from when I was looking to save money on student meals in college and everything else up here. But any questions about the market or anything currently in Harrisonburg that y'all want to touch on, Elliot?
So I did want to just ask your opinions. So we understand both regionally, locally, and abroad the country. There's a rooftop shortage, there's lack of inventory. But like, as far as like the Rockland County Harrisonburg market, or even in West County, like we have, the two large home builders are coming, and now they're coming, Horton's coming, Lennar's coming to build houses. So if you had a guess, and I know it's a guess, what would you say like they would have to build this many units for us to feel like an equilibrium as far as buyers and sellers? So right now we know it's heavily weighted on buyers and less sellers. What do you, if you want to take just a generalization guess, like, because I still think even if they come here and they build a bunch of homes, my anticipation is there's still gonna be a shortage. So I just want to know if people had a similar feeling.
Yeah, I mean, it would take a lot. I don't know. I don't have a direct number. I don't know if you have thought about an actual number, but I think it will take a good amount. And I mean, there's people out there that aren't moving. That's another piece of the puzzle here, is that there's a lot of people that aren't moving because A, they have a better interest rate than they can get now, and B, they aren't really excited about the products that are out there, or that are they fear the move itself. So if other supply came out, there might be more buyers there as well. They might be selling the house as well. So I don't know. I mean, I think it would take a good amount to really capture all the demand, and we have a while to go before it is more balanced.
That's my sense. These guys come down like Ryan homes are here.
Yeah.
And they're building lightning fast as far as building goes. There's still not that many homes that's added. Like some of these developments they've done where it took a year and a half, 2 years to add 50 homes. That's not a lot over 2 years with the population growth that the amount of millennials that need houses. Right. So you add a couple more large builders, it's not like they're adding thousands of houses.
Yeah. So I think we could calculate what you're talking about too. So balanced market is generally 6 months of inventory. So to see how the absorption is. I don't know that number off the top of my head. I don't know, Page County, for example, has less than 40 listings, and I think that's usually about a month or two of inventory. So with how the absorption rate has been, so you'd have to figure those numbers out. But I kind of agree with Matt. You would have to have multiple things come in, so new builds, if a bunch of foreclosures or something like that changes, or people start to sell from economic change or something like that, in order to kind of change that for the supply side of things. Any other questions about kind of the current market or anything?
I would say that it seemed like from the start of the year, kind of into the fall, people were a little bit scared, like, it's gonna roll over, it's gonna roll over. But as we headed into 2023 spring, it seems like if it's not the first time home buyer, people aren't as worried about the interest rates, and in Charlottesville, just the lid has come off of prices and it just keeps.
Going crazy.
escalating. And
Yeah, it was pretty slow in the winter. I think there was a lot of shock in the system. Like, I mean, I think it's hard if you're like pre-approved for $400,000 and then now you're like, I can only afford 300,000. The
Right.
price has just gone up. So it's kind of a tough pill to swallow. So there was definitely a lull in my business. I think a lot of people's over the winter. But yeah, I think I agree with you here too. It's just kind of taking off again.
Yeah, so I think still there's a lot of uncertainties, or that's kind of why we're all here and curious about what I have to say. And for those that don't know me, I've been in real estate since 2012. I bought my first rental property in college, and then I fix and flip a few houses every year, have some rentals, own about 150 lots, mobile home parks, and we're looking to buy more of those. So that's kind of my background, and these are some things that we're kind of considering as we're making new acquisitions. And like I was saying before, I want to make it conversational. So if you have some thoughts, questions, if there's something that you don't see on here that you think is helpful, like share it. So we have our next meetup, first of all, on the 21st of June. So potentially going to have a speaker, Mark Dolphenmeyer. I've got to get that confirmed by the next week. He's going to be talking about doing some real estate loans. So he's with Pioneer Bank. They'll do some construction loans and things like that too for your fix and flips. We're going to talk about what he has to offer, what he's seeing in the market as well. We just went over the market update report. So we're going to get into some strategies. And I just wanted to break it up into two sections for us to talk about. One is risk management for your current portfolio. So right now it seems like our inventory is low. Prices have not really drifted anywhere, especially in our local market. So these are things in case something changes, that we start to see more supply come on. We start to see houses sitting for longer on the market. That's something we're looking at to monitor with how strong it is here locally. But we're going to get into risk management for if you already own rentals and what to do with that, and then also for new acquisitions, because we don't really know. There's a lot of uncertainty in the market with how the banks have been having some issues. We've got record interest rate increases, and that takes time for that to play out. So we're going to try to do our best to address those two different aspects. So the first, I just have it all listed out, are some ideas for ways to mitigate your risk with new acquisitions. So especially if you're starting off, there's partnership. So if you don't know the renovation background, or you don't have good lender relationships, maybe you don't have the money, or you're just doing a lot of projects, you want to mitigate some risk by having half the exposure out there, you can look at partnering with somebody that's more experienced or similarly experienced to you. Second is more conservative underwriting and analysis. So I like to get Elliot's perspective on this, but a lot of banks are probably a little bit more conservative with their underwriting and performance for investors' loans. We're gonna touch on that a little bit. So try to get fixed loans, longer term ARMs, or lower LTV when you can, and then have multiple exit strategies for your projects when possible. And then going into the conservative analysis is also just your general market. So you can be more conservative by choosing to be in more recession resistant markets. So, we'll touch on that with what that means here in a bit as well. Any other ideas for ways to mitigate risk for new acquisitions?
I would say, we keep hearing there's talk about recession, is it gonna come Q4 next year, and will have an impact on real estate. But I think that from a banker's perspective, when evaluating risk, like we feel really good when a borrower or partners come to a deal and they got excess cash. Like if you can service the debt, if it just sits vacant, or if you can service the carrying costs while whether you're doing a rehab, flip, or new construction, it just makes us feel better. So, and I would say, like, as an investor myself, I've even trying to hey, maybe I need to like store up some more cash and be less aggressive because I need to, due to the uncertainty, what's maybe coming, so.
Yeah, I probably should have put that here. I have that under current portfolio.
Oh, okay.
So yeah, which has increased your reserves for issues like that as well. Any other ideas?
I would say just kind of clean up your personal balance sheet so that
That's good.
the previous deals don't carry forward, like maybe you've got an HVAC system that you need to pay off, or a little bit on line of credit, or, you know, OBX trip for the summer or something, just kind of clean up your balance sheet so that when you go on to take on new risk, it's just that and nothing.
Paying off old debt.
It's gonna creep into your new deal.
Yeah, that makes it more lendable too, right? So.
No, I tell you what, that makes it big, like, for those, you know, if we're in here because we're interested in real estate, you're trying to scale. I feel like, hey, Elliot, what's the number one thing I would do to scale? I'd be like, do not take on non-income producing debt. Like, if you need, you know, leverage to buy deals and get into deals to make yourself more bankable, you know, delay the idea of wanting that new shiny truck, having car payments, or delay, you know, financing your vacation. Like, the longer you can go with little to no consumer debt, and all that, you know, it just makes deals flip. Like, because we feel better. Like, okay, this person's like fiduciary, pretty strong. You know?
Yeah.
But they're willing to, you know, deny themselves for, you know, growth. So.
Cancel my Tesla.
Did you say sell your Tesla?
Cancel.
Oh, cancel your Tesla.
Alright, fine.
So I want to touch into a little bit of pros and cons to each thing. I'm not going to get really in depth. And so, you know, partnerships, I'll just give some examples. So you have joint ventureships. You can just do, have somebody as a private money lender where they're going to have a first or some sort of note on your property to secure the debt. Those are options to mitigate your risk. If you're being really tactical too, with some of the ways you can get loans, you can have it to where it does not show on your balance sheet if you get some creative financing. But some of the pros with partnership are you have half the financial risk, assuming that that's also what's agreed in the joint venture. Potentially twice the effort and skill to go into a project to get it completed and managed. So you might have half the work, ideally, and potentially do twice the amount of deals if the market and timing supports it. So you obviously don't want to go gangbusters on things if you're not feeling sure about the market, but having twice the amount of people should theoretically have you doing twice the potential deals, and ideally with a good system, even more than twice. So cons is you get half the upside on each individual deal, and you have disagreements and conflicts between partners with maybe the renovation or how long you want to hold it, or if you want to renovate it. And another con could be if you don't haven't properly vetted a partner, then you can have similar visions in the sense of you don't complement each other's strengths. So you both have the same weaknesses, you both have the same strengths, and then that can also be an issue too for deals. Any thoughts or questions on that one? Partnership? We've got conservative underwriting for the next one, which just means be careful when you're looking at deals. If you're having to have everything work out perfectly, no matter what the market's like, it's never something that we would suggest. We're in an interesting point in the market where the prices have not softened much. Investments buying, you're still seeing fierce competition. You're not seeing as many of the crazy bidding wars, but still fierce, especially if you're trying to get short-term rentals or long-term rentals. And there appears to be more economic risk than the past few years ago. So you have higher interest rates. We've got a little bit more of the banking uncertainty. So here are some examples of conservative underwriting that we personally use. So when you're going to underwrite a project for a fix and flip, just assume that's going to have 5 to 10 more percent in the project cost. Your holding period is going to be longer. So that's going back to the COVID days where it's hard to get supplies and laborers are still pretty backed up from our experience. And if the deal still works with that and a little bit of a decrease in sales price, so in case sales prices do get hit a bit, if it still works, then it's, you try to break the deal and it doesn't get broken, so go for it. Rental properties, same thing, try to project your worst case scenarios. So how does it look with higher vacancy rates? Because right now they're essentially nothing, they're almost zero. Decreased monthly rents. So that is something that historically in the last cycle, we saw some decreased rents in our markets. People think rents only go up and they don't. and slightly higher repair costs. So if you have more turnover, you're gonna have higher repair costs as well. So how does that impact your numbers? That might just be an easy correction, such as increasing your repair reserves. For short-term properties, now, if you Google least recession-resistant assets, vacation rentals are gonna be one of the first things, because if people lose their jobs or lose their income, what are you gonna cut out? Probably vacations. So, one thing that I've seen a lot is people get the income or financials from a vacation property. AirDNA says I can make this much, so clearly this person's doing something wrong, and I'm gonna be able to do it better. So you better be very sure that you actually can, and then also be aware that the previous couple of years, at least for our area, has been, the banner years of Airbnb. So if you're projecting that it's going to continue to grow at that same rate, or even it has to stay the same for you to perform, then like that's something you got to consider with the risk there, because it's kind of taken off for those years. So what happens if it comes back? Any questions or thoughts on the underwriting? Any other asset classes you want to talk about with the underwriting that some people are interested in? All right.
I'll actually add one. It's something we're seeing a lot because there's a need for housing expensive is then thus the need for space. So a lot of what's coming online more is self-storage units, because people, either they can't buy their house, or they're renting an apartment, they don't have enough space in an apartment, so now they're having to get, or if they do buy a house, they can't buy the 2,000 square foot home, it's 1,200 square foot. So we're seeing that. I mean, I know it's.
So is it overbuilding with self-storage kind of what you're thinking?
Or buying existing assets, but yeah, I'm foreseeing that those things are just doing really well, because there's little maintenance expense. It's just concrete and steel, so there's not a lot of variables, and then people pay rent monthly, so steady cash flow.
Yeah. Yep. And you don't have to worry about the housing laws and procedures with that too. So, we'll get into loans a little bit, and if there's anything you see that you'd like to chime in, go for it. But for short-term projects, you're generally going to have an adjustable rate or a balloon. I keep a couple things in mind with those. So pay attention to the interest rate cap. So a lot of those loans, if you do have an adjustable rate, they'll have a cap of how high that interest rate can go. And the history of America, there's times where that's gotten maxed out. So like, if you really want to be conservative, what's the max that I'm going to have to feel on the pain on that side? And then always get the duration longer than what you think. So, if you're thinking that the project's going to take 12 months and you're getting a hard money loan, try to get it for 18 months, for example, and always have a way to where you can get an extension or refinance. You're not in a tough spot. So ideally you have a clause where you can just add another 6 months or something, put extra down, whatever, to protect you in the worst case situation. For longer term projects, aim for fixed rates when possible. You want to try to avoid prepayment penalties, because if you ever have something come up or you want to cash out, then you're going to have to be paying a fee to sell. And it also allows you to refi at lower rates in the future. And if you have to get an ARM, try to get the longest fixed period possible. So I think the most I've seen is a 7. Have you seen anything longer than 7 for ARMs? 10s for ARMs. Yeah. And try to always get non-recourse debt when possible. That just means that a lot of the bank debt that you get is going to be personally signed by you. So if the investment that you have goes under, then you're still personally liable for coming up with those funds out of pocket. If you get something non-recourse, then it means that you're not personally liable, as long as you don't commit things like fraud, et cetera. So another thing for new acquisitions is the multiple exit strategies. If you have a flip and you can rent it or do a short-term rental with it, if those are 2 different options and you've got 2 additional exit strategies with it, that helps mitigate a lot of risk. If you have an Airbnb and you have a great basis to where you can do a long or mid-term rental with it too, in the event something else doesn't work out. Because another kind of risk is ordinance getting passed or restrictions passed with Airbnbs. Then you're protected in that if that ever does happen. So a good question to just always ask is, what's your plan B? So another one is, let's say you're investing in an area that's more stable, it's a little more rural, it's doing well with cash flow, but you're worried about the market. you can always transition. I mean, here in Harrisonburg, I can't remember any of the figures for like 2008 or anything, but I think things held pretty stable here, didn't they? More or less.
Better than other markets, yeah.
Yeah. So this might not quite apply as much here, but you can invest in better, more historically stable markets. This is what you're looking for, which Harrisonburg represents the majority of these things. Is job growth, population growth, recession-resistant jobs / employers. So those are, education, healthcare, government-based jobs, and diverse employers, and low crime and below average poverty for the populace. So that is the main things. I've got an example here of a site that we kind of look at sometimes. This is a bit of an outdated picture from a slide that we had on Meetup a year or so ago, but datausa.io, bestplaces.net is another one. They can give you the information, and we can, if we have time after this, I can hop on if people are curious about it and show you like how you can see the rent amounts and everything. But they'll give you the median rent amounts, they'll give you the poverty rate, if it's growing, property value. So this one's, quite a bit off. Like I said, this was a couple of years ago. To give you a high level view if you want to be in this market or not. So any thoughts on new acquisitions before I switch over to current portfolio and risk management, things we're looking at doing?
One of the things I was thinking about as we talk about Airbnbs is I think there's definitely people entering that market space too that are not as concerned about making a profit. Like the tax incentives are good enough for them that it doesn't necessarily need to be a super successful business to be a smart decision for them. So when we're looking into buying, and that's not your scenario, it makes the competition even more fierce. Yeah, so it's tough. It's a tough market to get into right now.
A lot of 1031 money.
Yeah, and I think there's like a whole section of like doctors that just to be considered. I don't know if they have to manage it actively to be considered like a full-time real estate professional or a spouse of a doctor or something. But there's apparently some sort of, I don't fully understand it to be honest, but there's some sort of tax benefit to.
Yeah. For just ongoing income yearly is what you're saying.
Yeah. You get a cut, you get a break on taxes for owning. It's different than owning a long-term rental.
Maybe, would you know, because probably they're getting real estate professional status because it's active? Yeah, okay.
And so that's why some people investors are getting like the license, even if they don't technically list, maybe they want to buy their property, maybe when they sell it, but it's just the tax benefits from it.
Right.
Gotcha. Yeah. So for the current portfolio risk management, we're just going to touch on 4 things. I'm flying through here, so we're actually almost done, but we've got the loans, which is pretty similar to what we talked on before. I'll go into rental property on how to do that. So this is the high level view on it right there. It's just be extensive on your screening, make sure you're doing background checks, the applications, verifying income, the losses and vacancies. So when you have turn, ideally your tenant's gonna let you know 30 days or so before, so you can start the marketing process beforehand. But if you have turn from an eviction or somebody just randomly moving out, because we all have that too, where they text you a week before and say they're almost out. So that's a big cost, is in the vacancy and the turn. So there's been a lot of people that have been just pushing rents every year, and that's great. That's what you got to do, but also pushing the market and beyond market. Sometimes you'll see that, especially in the commercial space I'm in, and that for the regular type of rental property is, a little bit more risky, and especially if things do start to soften, then, is being $100 under rent going to make a big difference for you, or is it better just to not have that churn? So in our experience, unless you have a big portfolio, then you just have a handful of properties. If you have a deal at $900 a month for rent and the market's $1,000, and you feel things are softening, instead of bumping it to $1,000 this year, you can bump it just a little bit, and that way they're not potentially moving out, and then you're losing that $75 for the whole year anyway in the turn. Lean operations and inspections, good quality rentals for your clientele. So lean operations just means you've got a good team that can manage it. They'll do the maintenance for a fair price, which needs to be very reasonable. doing biannual inspections or something we recommend, and then finding good quality rentals for your clientele means you're not just slapping paint on something that's got a lot more issues than that and throwing somebody in there. So you see that sometimes too. So people are likely to treat things how you present it to them. So if you have a clean car, they're probably not going to throw stuff on the floor. But next is insurance. So making sure your portfolio is properly insured. I was never claiming to be an English major, but so just touch base with your insurance agent to make sure you have a good one that's familiar with real estate. It's something where, especially as you're growing, you're going to want to touch base every so often. You may want to consider umbrella insurance depending on how big you are. So the other thing with that is as property prices increase, you need to make sure your insurance policies are adjusting properly to account for the replacement costs. And then the final thing is increased capital reserves, and increased capital reserves is what it is. So we're talking about keeping your cash on the side in case of a rainy day.
A couple questions if people want to chime in here. I know that right now, I went to a property management conference for Virginia Realtors, and right now a big push was getting the smoke detectors checked every year. I don't know if you all are doing that, but that was an interesting one. And I've been trying to work that into my routine to have the I think they basically just replace the battery like every single time so you can say that you've done it. But then also having some sort of like little inspection that contractor then does just to kind of ensure the property is in good condition. Does anybody do something like that or have a system they recommend?
For a cost, I have written in that I'll change my air filter, so it gives me an excuse to go in and kind of lay eyes on it. And obviously, well, changing air filter, everybody's seeing inconsequential, but it's actually to help you with your HVAC system, which can be a costly expense down the road. Because if they have pets, they don't pull out the filter, that air gets in there and it's not allowing good airflow. It can, overwork the system. So, but a similar spirit, you want to get in there and make sure everything's okay and there's no alarms going on. So.
And do you go every month then to change the air filter?
No, once a year.
Okay.
Yeah, once a year.
And then I was also gonna say, is it true? I've heard some people say that if you don't have your properties in like in an LLC, that an umbrella policy can kind of do something similar to for risk for your liability. With that line of thought, I know that there have been some more cases of people actually, like if you have a normal loan, a normal on the secondary market, conventional loan, and then you switch it into an LLC, that I've heard that people are calling that now because interest rates are low. They were low and they want to have the higher interest rate now, so it's a lot riskier to do so. I've never done that, but I know that was more commonplace before. So could an umbrella policy help with the risk mitigation? Anybody's thought about that?
I think the umbrella policies are very affordable. It's like $10 a month or something for $1 million, or it's pretty affordable insurance, I think.
I've gotten one on mine,
Yeah. Any other thoughts? You guys are quiet. I thought there'd be a lot more like input. So this is very short.
Yes, thing you talk about the loans, and for those who maybe haven't heard what a balloon is. So a balloon is a hard maturity, so it's not a rate reset like an industrial mortgage. It is a hard maturity where you have to requalify for the loan. So sometimes if you're a portfolio lender like non-one, then some lenders will do that. I would just say try to stay with them as best you can. And if your lender only offers balloons, then go find another lender. Because if you have a life event where you're not able to work, and therefore your income is cut in half, or maybe if you're married and your spouse has a life event, or maybe you have children, she decides she wants to stay home, or these unforeseen things, you basically just want to be able to get approved once and know the loan is in place for the duration of the term, as opposed to like 5 years, 7 years, I gotta go requalify, because you don't know what the future's gonna hold, so just something to consider.
That's a good point.
Yeah. And the good point on that, when I've gotten pitched on that, is Yeah, but we'll just approve you again.
That's what they always say.
But who knows, like if they're, you know, let's just say they were one of the banks that collapsed or something, just who's gonna be the one that does it, you know? Or like you said, the life event's a good point. We know we'll give you the balloon and then they don't, so.
And so to that point, like you don't know, like let's say you go to a little community bank, again, I work for one. And then in that time, they've either had a failure or they got bought up by a larger one. Their underwriting standards may change. So you may qualify that time, your financials could be the same, but they're like, well, you don't really fit our model. You know, that can happen.
Yeah.
So, but they're like, go find another lender.
Especially because it's really good when you're starting off to call a lot of lenders, because you might not be extremely bankable to most of them when you're starting out, but there's usually a small bank that if you have done your homework, you either have a partner or something, you can usually make it work if the deal's good. But like he's saying, if that 1 or 2 out of 30 banks gets bought out or goes under, then when you're trying to refinance, if things haven't changed, then it's going to make it tough. So for loans, the best option is to just get a time machine and refinance. So your next best option is to keep your LTV low. This is because if prices do adjust or anything crazy like that happens, you've got room to where you're not having to put money back into the deal at a time where you refinance, or if there is an arm and they want to change things on your LTV there. So that a lot of lenders like to keep that at least 80% of the loan on the value of the property. And avoid refinancing if you're using an arm. So evaluate your arm risk. If you currently have one, this goes back to looking at what your cap is on the interest rate, what it can go to. And if there is a really high one, you might want to refinance a fixed rate investment loan if there's substantial risk there. So there are more and more 30-year loans for investment properties. So if you have an arm, you're probably getting a 20 to 25 year amortization now anyway. If you go to a 30, it might not change your cash flow with a higher interest rate. Yeah, you're going to have a lot of extra interest and 5 more years to pay it off if you just do the standard payments. But you also you can sleep a little easier tonight knowing that's not going to jump up on you. So rental property risk management. I'll be honest, I'd be happy to talk a little about what we do. I didn't have a whole lot of time to put this together, so this is just kind of the high level stuff. So we already talked about the more extensive tenant screening and approval criteria. We mitigate loss in the vacancy and turnover by not excessively pushing rents. So that's just something that we do a little bit of. Getting that last little premium out of it has not proven to be something that works for us, and that's just our personal philosophy. Improve the property protection by conducting rental inspections annually. You can do the air filter idea is a really good one. But this can be as simple as making a checklist of all you want to check your plumbing, you want to make sure there's no roof leaks, you want to make sure there's no electrical hazards, your smoke detectors, your air filters, and you can just hand that checklist to a handyman and have them go and do everything for you. And then have them take pictures of any issues that are there that need to be repaired so you know exactly what needs to be done and how much that should cost, more importantly, so you're not fixing a small $100 project for $500. Make sure you're offering a good quality product for your clientele. So repeating myself again, but it's as much as you can, try to keep up the property. Every time we turn a unit, we try to improve it in some way. So get it back to being rentable, but then also improve it. Improve management and maintenance operations to officially cut costs. So this is something that we are trying to do a little bit more. It's hard to struggle with, but that can just be tenant communication, making sure that their maintenance requests are getting fulfilled as quickly as possible. So that way the tenant's happy, they're less likely to move. If they have any other concerns that can be addressed that just has you going a little bit extra, then try to go for it if you can. Any property management or like operations questions?
This might not be in the vein that you guys are in, but what kind of demand are you guys seeing for like rural rentals, or is everything like cities, the only place that people are looking for rentals?
So personally, the majority of my portfolio of single family properties is in rural, so it's Page County. Very high demand.
Because we're in Broadway, Timberville area, and one of the options we're considering is, do we turn our home with a low rate into a rental and then try to find another house, maybe as part of the cash flow from the other one until the market recorrects and we can refi and not have to worry about that.
Yeah.
Is that a good option? We just don't want to try to go that route if there's not going to be people trying to rent in Broadway?
I took one off the market because I rented 2 units. And I took it off the market 2 weeks ago, and so people calling me saying that like, we heard this is for rent. So there's a lot of word of mouth more in the rural communities, but we still do it on Zillow and advertise that way. But yeah, I think you'll have really good demand. How big is the house?
Like 1,200 square feet.
Oh, yeah.
It's
Okay.
not too bad.
Yeah, that's ain't around.
Yeah. So I was gonna say you're one of the risks that we look at too is you don't want the house to be too big because then you have a lot of maintenance costs when you do turn it over. But that's like we try to stick between 1,200 and 1,500 square feet. That's perfect.
I have a friend who rents her place out in Broadway, and she gets 1,400 or 1,500
That's what we were looking
a
at.
month.
There you go.
Yeah.
Now we have to find another house to move to, so that's the issue.
Yeah, but
That's the hard part.
Yeah,
if you
right.
can, I mean, if it makes financial sense for you though, at least you're paying town, you building more wealth with 2 properties at once. Definitely don't put yourself in anything that's, gonna make you cash poor, but,
Right.
yeah. Any other thoughts, questions? That was a good one.
The other thing, I've been talking to, I used to work at DuPont, so I know a lot of the lenders there.
Yeah,
And something probably would, if we do that, is you can change the titling to a business like an LLC and keep the same rate with that.
yeah, do a quick claim.
So like if you do it the right way, you can have it protected with the LLC, rent it out, so you have that asset protection when you go buy a new place, and they won't change the term or anything like that. So we might do a HELOC also if we go that route before we rent it out. Because that's one of the hard parts I've heard is getting a HELOC on a rental.
Yeah,
So we could have a HELOC in place on a rental.
Yeah, definitely.
Before we move out.
That's huge. Yeah, you get a residential, you use a relock instead of a HELOC if you do it otherwise, and it's not as good terms. Yeah, that's awesome. I would just keep a pulse on the market as well, just like Facebook and Zillow, just any rentals that are coming out, just kind of see how those are moving.
Because we're kind of torn is, do we go that route or do we use the HELOC and use that as like a down payment towards a rental? And then after we like do that, refi part of that out after some season. We don't know what route's better to go.
so stay and then buy one with the HELOC, is what you're
We
saying?
can pretty much go either direction.
Yeah,
Because we could probably get a HELOC for maybe like 70 to 80, which is not a lot, but that plus funds, cash on hand, it's a secure place to know which route would be better to go.
well, you could probably get something for like 5% down too, right?
Right.
So,
Are there rules about getting a HELOC and leaving a house, or?
that'd be a good
We
Elliott question.
cannot refi the loan after, but our fixed 30-year is at like 3.8, so we don't care about that. And then a HELOC is adjustable, so if the rates go down prime, it's gonna go down by itself.
I think, so have you all been in since '08? Because I'm curious about how HELOCs work then. Like if people were just like, hey, I don't wanna do that line of credit anymore, we're just shutting it off overnight, like,
Sometimes it is buried in the, because when you sign those notes, it is so long, there's so much charge. Sometimes there is buried that the lender reserves a call. So they can call the note.
yeah.
So if they got nervous, like, hey, we think values dropped 30% in the community, we're gonna start calling these things. So, and that's just one of those things, you just need to read it and maybe even ask your lender, hey, is there a call feature in this? But to your question that you had asked, if you can, if you have a primary home and you decide you wanna put a HELOC on it, if you decide to leave, then there's nothing, again, it goes sometimes like it's in the business agreement or the loan agreements, but if you never informed them, I don't think they would call the note, but, as long as you're paying.
Is you paying for it?
Yeah.
Yeah.
You're fine with that.
Because I did that on my first house, and I still have the HELOC. I will tell you though, because I was where they were gonna call it, I changed my address to a PO box. So that way, when they were like, Ellie, why did you change your your mailing address to this house over here? So by putting it as a PO box, they never knew, and so my statements were there, so.
Yeah. That's what I was curious about too, is that, so we've tried to just refinance out where we could, and that way we don't have to worry about if they ever just say, you've got this HELOC of X amount sitting here, but now the buying opportunities are here, we're gonna take it away, we're not gonna let you use it, so. That's a thought too, but any other rental property questions?
This might be more of an Elliott question. Are they less likely to refi a rental now with credit getting tighter?
So if it's going through like if you're going through the secondary market through Fannie Mae, Freddie Mac, then it's not. It's still facilitating credit just fine. Yeah, it's only like the larger deals that where it's also based on it's like debt service coverage ratio, meaning it's profitability. So if the profitability is the same, but the P&I payments, principal and interest payments are higher, then you're really your take home, if you want to call it, the cash flow is less. So that's becoming a problem where deals that when rates were lower, people could leverage 8% and still may have to be cash flow positive after debt service. Now, honestly, what I'm seeing here is like it has to have at least 30% equity into it, even though the bank may allow you by policy to go up to 80%. It just won't pencil out. So it's like 65 to 70% for multifamily and the commercial real estate. But if it's 1 to 4 family, then I would just say go through the secondary market and get yourself fixed rate loan.
What do you think about that? Because then, so you've got 65%, you've got more equity now, so you've got lower cash on cash return. You can get higher yields by going with a money market fund or something now, with pretty much no risk. Like, we've seen some softening in the commercial market, but what do you think about all that? Because there's like, we've got inverted cap rates now, like all that stuff's pretty crazy, you know?
Yeah, I was bringing that up last time.
Yeah.
It is really weird where I think that sellers still haven't
Come to reality.
come to reality that until like people quit buying real estate, then it's not going to change. I think what's holding up, and this is, I like speaking the title, but I think that what's driving real estate is, demographically, the largest group of wealth is baby boomers, and they're retiring, and they're looking for somewhere places to put their money safely. So that's helping keep real estate up and from a larger price point.
Yeah.
Kind of like what you're talking about in the resort, like people like doctors, like people, high net worth people, or people are retiring. I also think like the second factor where you're seeing like apartment complexes and those things are large assets, it's money coming out of from outside the United States. They're still like, hey, American real estate, they're still safe that. So the capital's still pouring in. So, but it has to change because people just can't keep paying these prices for a cash return of like 3%. Like that doesn't, like, who would do that? Or be cash flow negative the first 2 years, like,
I see it, what I see with a lot of that underwriting is, unless you've got something that's just still got a lot of rental rate upside, then even let's say the market rent for a property is $600, whatever it is, doesn't matter if it's a chair. They might be pushing it to $700 because we have such a shortage of inventory. They're still getting it, but if anything shakes loose on that end, then it's like, okay, well, this is actually worth $600, and they're going to take a haircut there because they needed to get that $700 for their performing the numbers to work out. But yeah, so we'll see. That's interesting because I've seen the cap rates come up a little bit, but still not as much as it probably needs to. Because we doubled the interest rate, so. So insurance, very short, just verify your property replacement coverage. The increased amount is what's important because we've had some increase in prices. And then confirm you have adequate general liability coverage for your portfolio size and property type. And the best risk management strategy is it's buy at a great price. So it's all about the buy. If you get something that is at an excellent price, 6% market value, then it's protecting on multiple different sides. So, any other questions?
that was really good.
Thank you. Took a lot of time preparing that. So our next meetup is June 21st, and we can just talk about anything else. If you have any other questions, if guys want to see some of the sites I was talking about, or hear about some of the stuff we're doing. So we're currently still offering on mobile home parks. We've got about offers on 200 pads out right now. So that's pretty cool. Or anything else real estate related, I'm happy to talk about it.
When you say offers on 200 pads,
Yes.
is that like a group that's a park that you're buying, or like a couple different parks, or?
These are
just you're buying a lot.
buying a lot. What do you mean by
You're
buying?
buying a pad.
Oh, buying a pad, gotcha. So we, the company that we have, my brother and I, has owned 3 for the past few years, and earlier this year I've started to combine forces with another team that owns 12 here in Virginia. So we are gonna be, those offers are on 2 separate parks that own about 100 each, so it's 100 each in each community. And so we're looking for more deals like that. Still really tough to make them work though, like you were saying, so.
But as real estate continues to go up in cost, and I just don't see how it's gonna come down with lack of labor and supplies. We've seen it soften, and I do think it's actually not a bad time to build actually investment property. But generally speaking, it's fairly costly to build. Like the lowest asset level for housing is mobile home. I think that's the safest place. Like if you have a lot of cash and you're like, what's the safe place to put money? I think that's it. That's the play.
Yeah, or treasury bonds.
Yeah.
Yeah, but people, I mean, self-storage is another one that's really good that a lot of people are going to for recession-resistant assets. It's just like the thing you talked about there, you gotta be careful of competition over building since it's easy to throw up. So from what we've seen, the top 3 are parks, apartments, and self-storage for those. Yeah.
What would be your preferred leverage on rental property? Like when interest rates were falling, it was attractive to refinance and leverage the debt to a certain point. But now, I may have trapped equity, but it's a 3 or 4% loan. And, if I were to refinance, I'd take the money, but I'd be paying a lot more interest and the risk on the individual property would be much higher.
Yeah.
Be a lot more expensive.
So you're saying what we would do now?
Or what would be your preferred leverage on a property? Is it around 80% or as much as you can get, or?
Yeah, so unfortunately, answer with that, it's gonna be, it depends. And so ideally, we're never over 70%. And depending on the property type, if it's something that needs more maintenance, or I'm seeing that, like we have a multifamily property that's a little older, has more turn. So I think the leverage on that is like 50%. And that might not be the best move, but when the fixed rates were there, we refinanced to that amount so that our philosophy was if we ever needed to tap that equity, then we would probably just use that property as collateral.
Sure, kind of makes that property much safer.
Yeah.
As a standalone kind of unit.
Yeah, so that, I mean, I don't think we have investment property wise ever gone over 75% LTV, because a lot of times we're buying those rental properties, we're forcing appreciation too with renovating and stuff. Anyone else have a preference on that?
I would say if we assume that inflation is 5% right now, like you have positive leverage, where like that your dollar is actually stronger at 3.5% interest rate than it would be, if you got a rate at 7%, then you have negative leverage. So to be a positive leverage is like the sweet spot lending. So it's not a bad problem to have.
Math wise, the leverage, it's inflation and you're winning. But it seems like it's easier to take on a lot of debt than it is to actually manage it.
One thing that we don't have, I wish I could be like, this is the number that we always hit, but that we'll look at is return on your equity too, like you're saying. So if one property was it appreciated very well and you've got, you're cash flowing a few $1,000s is just a long-term rental, but you've got $150,000 of equity in it. What's that ROI? It's not much. Can you do better somewhere else? And that's when it's like, okay, can I refi? My risk isn't too bad with the payment, or does it make sense to sell it into something I can do better? But that also goes with your debt too. Like my wife has a loan on her car and it's like 3%, and does it make sense to put 10 grand on that or just save that and get higher yield somewhere else? So, yeah. Thoughts? I haven't seen you guys in a while. Haven't heard much. So how are things going?
Good.
Good. Y'all seem busy. I see a lot of posts on Facebook.
Yeah, we've had to, on the real estate side, we've had to switch to flipping. It doesn't make sense to hold anything right now. The interest rates eat up every money you make on it.
Yeah.
It kind of sucks because our real goal was to buy and hold everything that we could before. That's our long-term play. So we're just trying to build up cash for right now for down payments for when the rates make a little bit more sense, or just for a rainy day.
If something changes, yeah.
Yeah.
And that's even with the parks too. It's like you know, we're just looking anywhere in the southeast, and it seems like people are just buying just to break even on things, so it makes it tough.
Sure, those record low interest rates, like borrowing a lot of money, like even if the price is high, you're like, okay, well, this is still gonna get me in the long term. But
Yeah,
now that you have high rates and high price, it's just not as attractive.
yeah, it seems like the top like just blew off there, and then people were like, okay, this still makes sense, even though these are like crazy prices, and then now the rates are up and it doesn't make sense anymore, but the prices haven't dropped, so it's like, I don't know.
Like getting the lowest interest rate is like a badge of honor, you know, if you can get it under 3, what can you do?
Yeah,
So,
people got down to what, like mid twos with 15 years? Something like that?
I heard that Mark Zuckerberg, one of the regional banks that may have gone under, gave him $1 million, 1%, might have been adjustable, but it was fixed for a while. And,
That's nuts.
Yeah, yeah. Wasn't there negative interest rates in some countries there for a little while?
Yes.
Like Greece, I think Greece was paying, yeah.
Mhm.
Yeah, well, I'm gonna stop standing up, I mean, we can keep talking, I'm gonna stop standing up here, I feel weird, so.
Industry.
you were saying maybe move and potentially buy a home.
Yeah.
I mean,